Get started. We have 18 people so far. Okay, and yeah, I'll just add people as they come. So let me just jump straight to sharing the slide material. Let's just meet everybody. And let me go into slide mode. And yeah, we actually have some videos to watch, so that should be a nice break from just listening to me. Okay, so let's just get started. So just to summarize what we covered yesterday, we talked about the illiquidity, and from an institutional investor perspective, we're interested in two aspects of illiquidity. So one is the inability to meet our financial obligations as they come due, and the other one is earning the illiquidity premium on our private assets, such as private real estate, private equity, and infrastructure. And then we talked about a liquidity crisis, what triggers a liquidity crisis, and what are the actions that you can take to manage your way through a liquidity crisis. And we talked about the LCR, for example, and then we evaluated we talked about what the, sorry, I'm missing one more person, two more people. So then we talked about how you can interpret the illiquidity risk premium, and you can think of it as a payment for giving up the option to exit a bad investment. And then we estimated the real estate risk premium, and we identified it as being the cap rate minus the 10%, or sorry, the 10-year real yield. And in the US, you could measure that from the TIPS market, for example. Okay, and then carrying on with our special topics before we get into the main body of the lecture, which today will be hedge funds. So I view the next two lectures as a pair, and they deal with value add strategies. And so the first thing we do is this lecture, we look at hedge funds in more detail. So that's a little bit higher level. And then the lecture tomorrow, what we'll do is we'll actually look inside to the types of trades that hedge funds will do. And the reason why we have an emphasis on hedge funds is because, remember, one of the main motivations for going into asset management is to outperform a benchmark. And so hedge funds are like a convenient topic to look at, because they're essentially asset managers that are specifically designed to generate alpha. So just to give you a contrast, like say like a mutual fund is also designed to attempt to outperform a benchmark, but they typically will tend to only deviate from the benchmark in a small amount, and whereas hedge funds will try to outperform benchmark in taking much more active bets. So let me give you, like, just to illustrate that difference. So if you're running a mutual fund to track the S&P 500, your starting point will be that you will buy all S&P 500 stocks, so all 500 of them, roughly in market cap weighted proportions, and then you will do some kind of ranking process in those stocks, and the ones that you rank favorably, you will slightly overweight. So maybe, at the one that ranks highest, you might overweight it by 1%. And then the one that ranks worst, you might underweight it by like 1%. So really, you're just making very minor tilts relative to your benchmark, with the hope that you make enough of these tilts that you can cover your fees and maybe add a little bit extra outperformance. But it's not like if the S&P is up 10%, it's not like you're going to be up 15%. You'll be up maybe 11%, or you may be down 9%. And the motivation for that is because if you significantly deviate from the S&P, you're not really delivering what the investor really wants, which is essentially US large cap exposure plus the chance of a little bit of extra outperformance. So if you deviate too much, you're actually not delivering what the investor is expecting. On the other hand, the hedge fund is almost the opposite philosophy. It's set up entirely with the goal of outperforming whatever index you're referencing. So that's why we look at hedge funds, just because they're the most pure example and of attempting to create value add or alpha. So, but let's first turn back to today's special topic, and that's distinguishing between institutional investors and retail investors. And so here I just make some like bullet points on what's the distinction. So if you're an institutional investor, the philosophy is that you're sophisticated and you don't need all the protections that a retail investor would need. And so that's this idea of caveat emptor, which is like buyer beware. And so if say Goldman Sachs comes up and tries to sell some kind of exotic structured product, it's expected that we will have the ability to evaluate those investments and make a informed decision on whether to purchase it or not. And we have, whereas the retail investor, that's not the case. And in fact, that's good news for you guys, in the sense that you guys will oftentimes be the people doing the analysis in those types of more exotic or private investments. Institutional investors can access the over-the-counter derivative market. We have access, or institutional investors have access to private investments, so private asset classes. We also have access, I keep saying we, so just whenever I say we, this thing, I'm using the term of me representing OTPP. So we have access to the bond dealer market. And so to contrast that with a retail investor, if you want to buy a bond, you would look at your, and I'm going to assume we have like a discount brokerage. So you look at the bond inventory that your discount brokerage happens to have, and you can select to buy some of those bonds from that discount broker. But if you're able to access the dealer market, then you can deal with all the other banks that all have their own inventory of bonds, and you can get like a quote on a particular bond that you're looking for, and it's much more liquid and much more choice of bonds that are available as an institutional investor. We have access to the repo market, which means that what we're able to do is take a government bond, hand it over to the bank, and as they will hold on to it as collateral, and they will give us the cash for in exchange. And that's effectively allows institutional investors to borrow at the risk-free rate for all intents and purposes. And whereas you as a retail investor are unable to do that. It's not like, even if you have a government bond in your account, it's not like you can tell your discount broker, yeah, please lend me money against that bond. This is just not going to happen. So rather, most likely, if you have a broker's account, you're probably borrowing at like prime plus number, as opposed to the risk-free rate. So that kind of gives you an idea of an institutional investor. So they typically have for in exchange for taking responsibility for their own decisions, and not relying on the protection for various like regulators and governments. Um, in exchange for that, we get to participate in the derivative markets, private markets, directly dealing with in the bond market, and access to borrowing via the repo market. So those are a lot of advantages that an institutional investor has that a retail investor simply doesn't have. But there are also there's a flip side as well. So there's some advantages that a retail investor has that institutional investor won't. And we'll talk about those a little bit as we go through the next couple of lectures. But just to give you one example, so there's certain size of a stock that is too small for an institutional investor to even bother to look at. And so say something over like, so under like $200 million, for example. So that just doesn't get on the radar screen. Whereas there are many like $200 million type securities listed. And so that's an area of the market where that a retail investor is able to access that's institutional investor is not. So sometimes your small size can be an advantage. Yeah, we'll talk about this a lot more. Let's just give you a foreshadowing. So now I turn attention to what it's like for a retail investor. So retail investors are regulated. Your trading accounts and bank accounts are insured. If your trading account will be insured by, I think it's Canadian Investor Protection Federation. But anyway, you're probably aware that your bank deposits are insured up to a certain amount, and then your trading account is insured up to a certain amount. I don't think so if your broker account goes bankrupt, you should be made whole. Similarly, like if your bank goes bankrupt, and I don't think there's been examples in modern times where this has ever been an issue, like a retail investor has ever suffered a loss from a dealer or broker or a bank going bankrupt. So retail investors are quite well protected. But in exchange for that, we've obviously limited menu of investments. So retail investors can easily access mutual funds, ETFs, Canadian US stocks. It's possible if you go with a more like, I guess, sophisticated broker dealer, like, sorry, discount brokerage, like, I think it's, was it IB? Is it Interactive Brokers? So I think Interactive Brokers has like more offerings, so you can access foreign markets. Fixing if you have open up a futures trading account, that's just like a specialized account with a futures clearing margin. You can trade in futures, so that would be like pretty sophisticated for a retail investor. A lot of retail investors actually participate in the options, like buy and sell options, so that's really accessible. Like I said, you're limited to the bond inventory that your broker happens to have, or your discount brokerage happens to have. If you're an accredited investor, which really I think is a term both applicable in the States and Canada, it's really just a measurement of either that if your annual income is sufficiently high or your total wealth is sufficiently high, then you can qualify as an accredited investor, and that will allow you to make some more like exotic investments. Like for example, an accredited investor will be able to invest in hedge funds. But then the flip side is that unless you're talking about like a significant amount of money, the hedge funds are probably not so interested in having a small but accredited investor as an investor. So, like let's say, just to put some numbers beside it, like say you want to invest $100,000 in a hedge fund, it's probably not that realistic. because the amount is just too small. Obviously, we've talked yesterday about real estate as an investment, a perfectly valid and good um, asset class that's accessible to retail investors. And obviously, for fun, I put crypto assets. So I'm not aware of any institutions involved in crypto investing. Okay, so now let's I'll give you a little bit of background on hedge funds, and then we'll do the case. And the case is very similar to the exercise we did for constructing like a beta portfolio, or like um, uh, like an index type portfolio. So, you know, where we picked like such a percentage of global equity and a percentage of corporate bonds and a percentage of like momentum active strategy. So we're going to do the same, similar exercise, but we're going to do it for a portfolio of hedge funds. And so the distinction is that hedge funds aren't really tracking, like they're not actually earning any identifiable market risk premium. So they're not earning like a bond risk premium or equity risk premium. They're supposed to be doing like unique things to generate alpha. So what you're building is really like a very different type of portfolio, because you can't rely on all the theory you have on risk premia to build that portfolio. And rather it's a pure alpha generating portfolio. That's the objective. So we'll do the case, and then that should take us to our first break, and then we'll come back and we'll watch some videos of some famous hedge fund managers, and then I'm not sure there's more material to cover, but there's at the very least will be an exam question to review, which is also relates back to value add. So it ties in nicely to the lecture material. Okay, so let's turn our attention now to what exactly is a hedge fund. And so since a hedge fund is able to invest in all kinds of different asset classes, it itself is not really an asset class. It's more like an investment structure that is a way to allow an investor, meaning the hedge fund manager, allows the hedge fund manager to generate alpha as efficiently as possible. And one of the ways that that's done is by having like a fee structure that encourages making active bets, as opposed to just tracking an index. And so that the fee structure for that is this, like, you know, famous 2 and 20. And so the idea is that most of the money that the hedge fund manager will earn will actually come from the 20% performance fee. So they are aligned to most of their money will come from performance. So they're really incented to you know, earn high positive returns. The other thing actually that's not in the notes, but it's also typically expected that the hedge fund manager will have their own money invested in their own hedge fund. So that again is another big indicator of like alignment of interests. So and you'll always see that with the largest hedge fund managers, that they'll always have like the bulk of their wealth in their own, invested in their own fund. And so yeah, whenever the fund does well, that means that they do well. And yeah, so I said that this was a way, like a hedge fund was as like a like basically an investment structure that allows the hedge fund manager to generate alpha as efficiently as possible. So what that means in practice is that there's a lot less constraints on them. So hedge funds are able to use leverage, able to short, use derivatives, and invest in all kinds of different asset classes, including private asset classes. And so remember when I said there's a continuum from beta to alpha. And so, you know, if maybe if you're in a classroom setting, somebody may have pointed out, well, I can actually invest in like a leverage ETF. And in fact, we looked at leverage ETFs when we looked at oil. And in fact, there's ETFs that are not only leveraged, but they're short leveraged. So when I look through this list of what hedge funds can do, oh, you can also even make the further case that those ETFs are using futures. So and in fact, there are other examples of ETFs that are actually that use swaps credit default swaps, so all kinds of derivatives. So you may make the point, well, these advantages are not really exclusive to hedge funds because you can easily obtain them in ETFs, which is a very good point. And so this is one of those things, that this example where the marketplace is evolving, because when hedge funds started, they started like maybe in, I don't know, maybe like the 60s or something, but really it started to really take off in the 90s. So at that time, none of these ETFs existed, and I'm not even sure, like ETFs had just, I'm not sure when the first ETF started, but probably in the late 90s. And they're all this vanilla basket of stocks ETFs. So this era of these more exotic ETFs that allow the retail investor to access leverage and shorting and derivatives, this is like a relatively new feature. So I would say maybe in the last, say, 5 to 10 years. And so there's like an, you're kind of living through an example where that this activity is coming more, is started off as like a more exotic, like alpha type activity, like shorting and leveraging, and now it's becoming more like an alternative beta, meaning that probably like, mom and pop retail investors are probably not using leveraged ETFs, but actively trading, relatively sophisticated investors are using these leveraged ETFs. Yeah, and I just want to emphasize that the goal of these hedge funds is to deliver alpha. So that's really their reason for existence. If there's no alpha, it's just there's no need for hedge funds to exist. And then this gets more practical information other than this mechanics of how it works. So it's embedded within the word, or where the name is hedge fund. So some people kind of think that when they hear hedge fund, they have the idea that it's somehow it's like market neutral, and in other words, it's like fully hedged to market risk. So it's a little bit deceptive. So on the one, it's hedged in a more broad sense, in the sense that there's more of a focus on risk management. And what that means is that typically hedge funds shouldn't have as large drawdowns as equities, but also they don't have the same upside. So so I guess when you think of the word hedge in terms of hedge funds, think of it more broadly as just in terms of good risk management. Yeah, unlike ETFs and stocks and bonds, hedge funds typically report their performance monthly, and you're only able to buy and sell on month ends. And actually, we've talked before about lockups and redemption notices. So it's not like you're not really actively trading hedge funds. It's a slow investment process, both allocating to hedge funds and getting your money back from the hedge funds. The other thing to know is that, because sometimes you may hear things about that hedge funds that were true in the past but are no longer true. And so just to explain where this is coming from. So when hedge funds first started to gain popularity in the 90s, so it was around the time that Swenson was allocating to hedge funds, they were primarily the focus of like their investment base was primarily high net worth individuals, and these were not institutions. So Yale would have been like an odd an exception of an institution investing in hedge funds at that time. Rather, it used to be like essentially wealthy people, and what these wealthy people were looking for is a large returns. So and actually kind of lined up with the era as well, because there was a lot of alpha available. So the hedge funds initially were able to deliver these high returns that these high net worth individuals were interested in. But then as the hedge funds grew in popularity, they became more institutionalized, which means that more and more of their investor base became institutions. And as you can imagine, institutions have like additional requirements. So they'll want to see like, you know, separation of responsibilities between like um, the the uh, the finance department and the investment department. They'll want to see like a compliance officer. They'll want to see like a risk officer that doesn't report to the investment staff. So all these like kind of governance aspects. Um, so as institutions came in, as became more of the investment base, it made hedge funds become more professional in their own as their own businesses, and uh, it also made the hedge funds themselves become more conservative, because now they had to deliver more what the institutions wanted rather than what the high net worth individuals wanted. And so what institutions want is they want very steady and low correlated returns. So they basically look at hedge funds as essentially like almost like an enhanced cash. So you could hold, say, 5% of your assets in cash, and earn like the risk-free rate, or you could allocate that cash to hedge funds and make that cash work a little bit harder by earning this this alpha on top of it. So it's a way to incrementally boost returns. So that's the way institutions sometimes think about hedge funds. And the other aspect of hedge funds too, and this is something that's kind of grown over time, because initially hedge funds, institutions were like justified or rationalized or explained their investments hedge funds with the idea that hedge funds are absolute return vehicles. And so absolute return, you would think that means that they don't have like negative returns. That would be kind of like, you know, the easy conclusion to jump to. And so, but it turned out like during the financial crisis, hedge funds actually, you know, lost money along with everybody else. Similarly with the coronavirus, same story pretty much. So it's the hedge funds no longer kind of are thought of as absolute return vehicles. They're more thought of now as like it's a little bit more sophisticated way to think about it, is that they're uncorrelated return streams. And so an institution will actually be quite happy if you can deliver it an uncorrelated return stream, even if you do have drawdowns. So if you deliver like a positive excess return, so you are delivering some alpha, and that return stream is uncorrelated to the rest of your portfolio, that is actually quite valuable, because as you know, it may not boost the return, but it'll definitely lower the volatility of the overall portfolio. And as you know, institutional investors focus on the Sharpe ratio metric. And so an uncorrelated return stream is going to boost the Sharpe ratio, not on the numerator or return piece, but on the denominator or the volatility piece. So that's kind of the more like modern way of thinking how hedge funds fit within an institutional portfolio. And then there's a lot of ways that you can classify hedge funds. The main one is by strategy, and so that's kind of like, you know, and the equivalent, like the same way you could categorize equities in many different ways, like small cap, large cap, or value, or by sector. So there's lots of ways to categorize hedge funds, but really the main way is by the investment strategy. So examples of investment strategy would be like, and we'll go over this in more detail, but examples would be like equity long short, fixed income relative value, convertible arbitrage, merger arbitrage, so all kinds of things. And so that's the main way to categorize that hedge funds are classified. But you can also classify them in different ways. Like for example, some hedge fund strategies are directional. So in other words, like a trend following strategy will be directional. So it will move in the same direction as the market. Whereas like a market neutral strategy will tend to be obviously embedded in the name, that it won't be like statistical arbitrage, for example, tries to be market neutral. You could classify by the asset class of the underlying investments. So a lot of hedge fund strategies rely on purely on equities. So, equity long short is the obvious example, but stat arb is also an example. Others rely on fixed income. Others rely on futures. There's an awful lot of strategies that rely on futures. So like managed futures, obviously as an obvious example. Another way you can classify things is technical versus fundamental. And actually we'll talk about that there's a slide dedicated to that. So technical, an example of that, like technical would be like a pure quant driven strategy. As an example, like Renaissance Medallion Fund is the classic example of a pure technically driven hedge fund. Whereas Warren Buffett's not a hedge fund, but that's a perfect example of like a very fundamental driven strategy. And then there's a convergent versus divergent strategies. So some strategies, and this kind of, maybe you should notice like an overall theme within this course is that there are many ways to be successful in asset management. And so here's another specific example. So there's some strategies that their basic premise is that prices mean revert. So if something has is gotten expensive, chances are that in the future it's going to become cheaper. So it's going to revert to its mean value or long-term fair value, however you want to describe it. There's other strategies that are trend following, and they say, oh, if the stock market is going up, then I'm going to bet that it's going to go up, and the more it goes up, the more and more I'm going to bet that it's going to go up. And similarly, if the stock market it starts to go down, you will short the market, and then as it trends gets stronger and stronger, you will short it more and more. So, and both those strategies have produced positive alpha in the past. So there's an example of, it sounds like two opposite ideas, but if they can actually both lead to successful money management, or successful performance. The same way both David Swenson and Ray Dalio can be successful. Then another aspect is the way to think about hedge funds is how difficult is it to replicate. And so this is something that we think about in teachers, is that it's almost like a buy versus build decision. So if something is easy to replicate, then we would just do it internally. So we would build it ourselves, so to speak. And if something is difficult, then we're quite happy to invest in an external manager in a hedge fund. So I'll give you some a couple examples to make it more concrete. So let's say think about merger arbitrage. And so merger arbitrage is a strategy where you will go, like a company will announce that they're acquiring another company either by cash or stock. And so let's take an example where company A is going to acquire company B using company A's stock. And so then what merger arb will do is they will buy company B's shares and sell company's A shares. And that is betting that the deal will close. And because you're taking the risk that the deal will actually close, then you're in an extra risk premium. So it's like a deal break risk premium. And so you get paid for doing that trade. And so you can imagine that I could have a program where it says, okay, anytime a merger deal is announced, I'm just going to take 5% of my portfolio and invest in that merger arbitrage. And then the next one comes out and I do the same thing. And eventually I'm running a portfolio of merger arb deals. And obviously you can imagine that as the deals get closed and new deals get announced, and that you just keep turning over that portfolio. So you can imagine that that's actually a relatively easy strategy to implement. So why would you allocate money to a hedge fund manager to do that strategy? Whereas think of something where you're processing like thousands of ticker prices throughout the day, looking for subtle statistical relationships between baskets of stocks, like like within financials, like like TD has drifted slightly ahead of RBC, so we're going to like short TD and long RBC, and we're going to do that for like half an hour or something like that. So you can imagine like that type of strategy involves a lot of computing power, involves like a lot of purchasing of data, a lot of data scrubbing. So this is something that practically speaking, we would not be able to do internally, and typically institutional investor would not be able to do internally. And so that's something that would get, we'd be quite happy to pay fees. And yeah, it just actually, something occurred to me is like, but again, I just repeat this theme of this continuum. But you can imagine, well, what if, sometime in the future you have like an AI, and that AI just goes, buys and sells stocks. And so what you would be paying all these hedge fund fees for is now just sits as a little AI algorithm in your computer in your trading desk. So something to think about. Yeah, so here's a complete list of, I'm sorry, a more like a longer list of hedge fund strategies. So I've grouped them by equity-based, and then by credit-based, and these ones in the middle, like managed futures, global macro, those are, managed futures is obviously futures, global macro is, it's a mixture, but it's a lot of times it's futures. Fixed income relative value, that would be typically credit or government bonds. Multi-strategy would be all of these things. But yeah, so just to go through the list, so equity strategies is equity long short, equity market neutral, short biased. They're all just along the continuum of beta exposure. Activism, so that one is quite interesting. If you guys ever heard of a person called Carl Icahn, he's probably one of the most famous activist investors. I think Bill Ackman is another very famous activist investor. Statistical arbitrage, merger arb, which I just talked about, equity event driven. Managed futures is a trend following. Global macro is where you make economic bets. So it's more like economic driven. Various credit arbitrage strategies, distressed debt investing. You actually, you may see a lot of distressed debt investing in the near future, because there's an awful lot of companies that have declared bankruptcy. So typically what happens is, like for example, I think Hertz just declared bankruptcy. So what happens is in, again, we may deal with this more in tomorrow's lecture, getting into more details of exactly how all these strategies are implemented, but just to give you a flavor. So if you're a distressed investor, or you may invest in bonds for a company that has a good chance of going bankruptcy, because what happens in the bankruptcy process is that the equity owners get wiped out and the old debt holders become the new equity owners. And so the distressed investors are actually buying debt with sometimes the intention of actually becoming equity. So it's quite interesting. It's quite a successful strategy. Yeah, this is a little bit more detailed classification of hedge fund strategies. The reason why I show you this is because the case uses the data from the HFR Institute, so Hedge Fund Research Institute, and they're well known for publishing hedge fund indices. So there's a few sets of indices that are pretty much industry standard, but so HFRI are probably like the industry standard for indices. But yeah, so it's a nice classification, and it's the same classification we're going to see in the case. So that's just why I just wanted to show you that. So it's like equity hedge, event driven, macro, relative value. We talked in the previous exercise. We talked about fund of funds and how those were just really, if you're able to invest directly in funds, you're better off just investing directly in hedge funds rather than paying somebody to pick the funds for you and charge extra fees on top of it. So yeah, so really there's 4 core strategies. So now what I'm going to do is I'm going to switch over my sharing to the assignment just to give, and have my notes, but I'll kind of highlight some of the returns, and then from the case, just so they're fresh in your mind, and then I'll turn over to my notes and go through the points I wanted to make. So I should just jump directly to sharing. Okay, here we go. So yeah, so what I want to highlight is, as I said, there's really four main strategy categories. Equity hedge, and so here's a bunch. And one thing I want to highlight to you is that, remember we talked about like different ways of weighting an index. And so when you're talking about hedge funds, it's not so clear whether you should weight the hedge funds as kind of equal weighting. So you should count like as an investor, you would invest like a dollar in every single hedge fund within that strategy and then figure out the performance of that. Or do you size it based on the AUM of the hedge fund? So a hedge fund that has like, say 5 billion of AUM will get 10 times the weight of a hedge fund that's got like 500 million AUM. So since there's no clear answer, the index provider has actually provided both. So for every single strategy category, there's both a kind of equal weighted index, and then at the bottom they give the kind of market cap equivalent index. And then within it is the breakdown. So all these strategies would have rolled up into these kind of sub indices for the category. So that's the first category. Then another category is event driven. And again, you have got the equal weighted, market cap weighted, and then the various strategies. So you see activism, credit arbitrage, distressed. So we've actually already even discussed a lot of these already, actually. And then there's global macro. So it's commodity currency. So fine. There's relative value, and yeah, so there's like convertible arb, volatility yield, so fine. And then now we get to fund of funds, and so here's like various fund of funds indices. And then there's regional indices. So, example, like emerging market. I guess a lot of hedge fund strategies are like a lot of hedge funds are actually physically located in New York or the States, or the New York area, like Connecticut and New York City, and they also tend to be U.S. Focused or centric. But if you want to make sure that you have like global exposure, you can go to some of these more regional indices. And so there's like emerging markets, India, China, Japan. So it covers Asia, all this outside of North America. And then there's thematic. So this is kind of interesting. So so there's like a diversity. So and then there's a woman and woman access. So these are the, for example, a woman's one would be hedge funds that are owned or by women. And we'll talk about it a little bit through the notes. So if you think that, say, women make better investors, then not only on top of all the risk premium that you should earn by investing in the strategy for the hedge fund, but there should be an additional risk premium on top of that for capturing women being better investors. So that's what this index is trying to do. Certainly the diversity one is saying, okay, we're going to exclude the universe to hedge funds that have like a diverse management. So that's kind of interesting. And then there's even probably for me even more interesting, because it's the one thing that sticks out as an outlier from everything else, is the cryptocurrency and blockchain indices. And then there's risk parity indices. So I think we talked about those. We talked about that a lot in terms of portfolio construction approach. So this is a little bit of an outlier too, because it's not really a hedge fund strategy. It's just reweighting, kind of beta asset classes in a little bit more like balanced way. But they put these indices on here, so I just include them as an example. So what I want to do is just before I go through my notes, because at this point in the course, you should have some kind of familiarity with what a hedge fund is. But I don't expect you to understand what all the individual strategies mean. But we will actually cover that in the tomorrow's lecture. So by the end of the course, you will have familiarity with all these strategies. But as of right now, for this exercise, I'm not expecting that. But when and if we were discussing in class, what we would have a discussion about if we want to use these returns to evaluate performance, the question is which return should we use? So we've got the latest month return, we've got year to date, we've got the last 12 months, 3 years, and 5 years. And so I would make the case to you that really the only thing I should care about is the longest return history available. So I'm going to ignore all the other returns for the sake of putting my portfolio together and just look at the longest term return, which in this example, all that we're provided with is 5 years of history. So I'm just going to go with that 5 years in history. So I'm going to focus on this column in terms of my analysis. But remember how I said that hedge funds, like people used to think of them as absolute return vehicles, and so that kind of, they thought, oh, absolute return means that they shouldn't crash whenever the market crashes. So let's take a look at these returns. And what I want to get across to you is this idea that it's pretty obvious that there's a lot of beta embedded in these hedge funds, even though theoretically they're supposed to be pure alpha. Because if these strategies were pure alpha, what you should expect to see is that the year-to-date performance shouldn't be so negative. So this year-to-date performance captures the effect of the coronavirus. So that hit hardest in March, I believe, in terms of stock returns. So, but then April, there was a rebound. And so the characteristic of tracking the market, like the fingerprint almost for it, is a negative year-to-date return and a positive April return. So a very large year-to-date return and a very large negative year-to-date return and a large positive April return. And remember, I said that these hedge funds are targeting a LIBOR plus 500. So let's say LIBOR was 200 basis points over this period, last 5 years. If hedge funds were meeting their target, all these numbers in this column here in the last 60 months, those would be 700 basis points or 7%. So I'm kind of jumping around a little bit, but let's go through this list and let's see how many, like who's actually made LIBOR plus 500. So not even close, not even close. Okay, so healthcare, technology, the combination of technology and healthcare. Okay, that's a big surprise. So you have like equity, healthcare, and technology. So fine. None of the event-driven, not even close. None of the macro. None of the relative value. None of the fund of funds. None of the regionals. None of the thematic. Not even the risk parity. So it's a pretty bleak picture for something that's supposed to be delivering like LIBOR plus 500. And so that kind of indicates what I've been indicating to you guys is that in this current period where there's a lot of money invested in hedge funds, that there's not enough true alpha available. And for the average investor, you're actually earning net negative alpha. And so why do I say that the alpha is negative? That's because these are the total returns. So to come up with the alpha, I need to subtract off at least the risk-free rate. So you notice a lot of these returns are actually lower than the risk-free rate. And so and if that's the case, it's actually negative alpha. So anyway, let me go back to what I was talking about, how that you can see the fingerprint of beta in these returns. And so look how many like high returns there are for April and low bad year to date. So here's a couple of exceptions, so that's good. But event driven, exact same story. Macro. So here you see macro is a little bit better. It's a little bit more like, so here's an example of remember I said you could classify hedge funds with their directional versus more market neutral. So at least these guys are more clearly event driven, and equity hedged is directional. There's no doubt about it. Whereas macro is clearly more market neutral. So more muted returns in April and more muted year-to-date returns. And that was the point I was making, that if you're trying to achieve LIBOR plus 500, if you earn like 600 basis points in a single month, that's pretty unusual. So these guys are kind of not delivering the steady returns that people would have expected from hedge funds. So anyway, so macro looks pretty like, you know, not a lot of beta, so that's a good sign. Relative value, it looks like a little bit of a mixed bag, but I would say there's evidence for a lot of beta here. So evidence of that is the large year-to-date drawdowns, and you know, pretty good positive returns for April. Fund of funds just tracks underlying funds, so no surprise there. They have the exact same behavior. Regional, same story. So in other words, you couldn't really build a portfolio of regional hedge funds and avoid this beta. Thematic, exact same story. And again, it's our good friends in the blockchain that's the clear outliers, that their year-to-date returns are actually pretty good. And yeah, the risk parity indices, same. Well, it's no surprise that they're tracking beta, but because they're supposed to track beta actually. So I can't really hold that against the risk parity. So those were the survey I wanted to make of these. How like you as the you know, hedge fund analyst would evaluate and draw some conclusions from these returns. So which actually, you know, if you think about it, is quite a lot that you can read from these returns. Given that we're not even, like, all we're doing is all we've been provided with is returns, not volatilities or correlations or anything else. But you know, given some knowledge of how hedge funds work at a high level, given some knowledge of how the stock market has performed, you can actually read a lot out of this. So now let me switch my focus to the notes that I prepared for the case. Okay, so some of the stuff I've covered, but I want to make sure. So yeah, so there's 4 strategy categories, and then I say, like, the fund of funds is not a category, and then there's a little bit of, we could discuss whether the other ones qualify as strategy categories, and I kind of make the case that not really. And so one thing would be if the regional indices all look similar to the other indices, then there's not really any extra alpha available in these regional markets, which is actually may appear counterintuitive, because the rationale here is that we're seeking out market inefficiencies. So the intuition would be that you know, markets in other countries, particularly like you know, developing countries, their markets will be more inefficient, whereas the U.S. is probably like the most efficient market in terms of both stocks and bonds. And so it's kind of like, one actually might have expected the regional indices to have some extra premium, but it doesn't look to be the case. So I would reject the regional as a distinct category. So in other words, what that means, if I'm going to be like equal weighting to categories, I'm not going to include regional as in part of my weighting. So the next thing we get is the thematic one, which is actually quite like interesting, because then you're faced with this issue of do you believe that women are actually better investors? And you know, there's some like academic research that's been done that's argue that you know, you can link it back to testosterone and things like that. So that's fine. But I mean, as an investor, you don't really care about that. All you care about is, well, if it's true that women are better investors, then I should see an additional risk premium. And if there's an additional risk premium, I don't really care, like, well, like if there's some kind of reasonable explanation for where risk premium comes from, then I'm quite happy to invest in it. And so you just make your financially motivated decision. But then the question is, does the data support the extra risk premium from these like thematic strategies? So in other words, women-led hedge fund firms or diversified management team firms, led firms. And yeah, when you look at the data, it's kind of like, it's not a definite no, but it's not an absolute yes either. It's kind of like, if there is a premium, it's like really small, like, you know, an order of like tens of basis points just based on the data. So the data, unfortunately for the females in the class, do not support that women are better investors. So, but yeah, feel free to prove me wrong with a live track record. So yeah, so given, you know, that the returns are not compelling enough, I'm not going to include thematic as a distinct category either. So now, how about blockchain? So I'm going to reject blockchain uh, as a distinct category, not because is anything wrong with it, but uh, and in fact, it's performed really well. So it would have been actually great to allocate to it, but I'm not going to allocate to it because it's not really alpha. It's just a beta to the cryptocurrency market, and so there's nothing that stops the institutional investor or you as a retail investor for purchasing Bitcoin or any other cryptocurrencies. So like Ethereum, Litecoin, whatever. Um, so I would exclude that because not because I don't like it, but just because it doesn't belong as a alpha process. The same story with risk parity. There's nothing necessarily wrong with it, although the performance is quite unimpressive. But setting that aside, it's not an alpha, so it doesn't belong in a value add or alpha portfolio. So that arrives at my decision that I'm going to equal weight to these four categories. So I'm going to do equity hedge, event-driven, macro, and relative value. And so I would say that, well, you know, given I'm not like an expert at this point in any of these underlying strategies, um, I'm going to just equal weight. And so that's like a pretty good approach. The other thing you could say is that because of all these strategies look like they're delivering similar return patterns, that the volatility for these strategies are all probably pretty similar. So you might make the case that, oh, like equity hedged and look more volatile. So if you want it to be a little bit more sophisticated, you could say, well, I'm not going to equal vol weight them, but I'm going to, I'm not going to equal weight them, like 25%, 25%, 25%, 25%, but I'll equal vol weight them. And so somehow I'll kind of eyeball some kind of volatility and say, well, it kind of looks like equity hedge is twice as volatile as macro. So I'm going to overweight macro 2 times relative to equity hedge. That would be a perfectly legitimate and sophisticated approach. So remember I said that there's 2 choices of indices. So I'm just going to pick the representative indices for each of the categories. And so there's the equal weighted version and there's the market cap weighted version. And so when I look at this, the equal weighted portfolio is 127 basis points and the market cap is 61 basis points. So having said that, like I would actually not make a distinction between these 2 numbers. These numbers are roughly like 1%. So it's the difference between these 2 numbers is really this noise. And so yeah, it's pretty much similar. Now what I would do is I would compare this to the fund of funds. And every year I've done this exercise, we've always found that the fund of funds composite significantly underperformed the hedge fund portfolio. By significantly underperformed, I mean like by say 1 to 2%. But it turns out the fund of funds composite is also now like 1%, and so it's pretty much in the same ballpark as the hedge funds. And so I'm speculating that the reason for that is because the performance has been so bad across the board that there's really not a lot of drag in terms of performance fees. So if you're running a fund of funds, you're not actually earning a performance fee because the underlying managers have not performed enough for you to earn a performance fee. So that's my speculation why the composite is actually, the fund of funds is actually pretty close to the hedge fund performance. Yeah, and then I make the observation that these are total returns, but really the alpha is the excess return. So it's the return above the risk-free rate. So none of these really are delivering alpha, or they're actually delivering negative alpha. And remember what I said, that the risk-free rate is actually a pretty generous benchmark for the hedge funds. In other words, using the risk-free rate will uh, show the maximum alpha. If I picked other indices, such as like a stock benchmark or like a 60-40 portfolio, uh, the alpha would be even more negative for these hedge funds. So this is all not good news. And yeah, so then you know, obviously this is just a short exercise, but some of you will actually spend several years of your professional careers, I would guess, involved in measuring the alpha for these hedge funds. So you may be a quant on a hedge fund investing team, and you'll be evaluating managers. And the key thing that you'll be doing is you'll be trying to measure the alpha for that manager. And as we discussed before, measuring that alpha is a relatively advanced quantitative exercise. And it's not as simple as just looking at the returns, subtracting the risk-free rate. It's looking at, well, how do these returns move with other market factors? So can I extract out the true alpha? Because as I've said numerous times in this course, true alpha is expensive and is rare and it's worth paying for. And as you as investor, as you as the creator of that alpha, can charge a lot of money for it. Whereas beta is essentially free. Yeah, so then, and probably you as quantitative people are probably, you may be uncomfortable with these types of exercises, saying, well, I wish I had more data, I wish I had the correlation matrix, all that kind of stuff. So that's all fine. But I would just ask the question, did you need any more information to come to the conclusion that that over the last 5 years, the hedge funds have been a poor investment, and furthermore, that they're unlikely to be good investments going forward? I would make the case that actually you had sufficient information to make that conclusion. Now, it's almost this idea that you can reach a rejection conclusion pretty quickly, but it's harder to reach an acceptance or a decision to invest conclusion. Because let's say it turns out that the hedge funds had been delivering like LIBOR plus 500, but then it's still not a definite decision to say, yes, hedge funds are good. You want to go into the next level of analysis. Because let's say a 60-40 portfolio had a correlation of like 0.7 to the hedge funds and had like a 5% higher return. So if that was the case, then I would argue that even if hedge funds delivered LIBOR plus 500, compared to a reasonable benchmark, that they're actually still delivering negative alpha. But my point is that if something is just bad, you can do a minimal amount of exercise analysis to come to that conclusion relatively quickly. So if you wanted to debate me on that, and then because all we've done is look at is historical returns, and you can say, well, that's not reflective of future returns. And in fact, like that's what mutual funds like say all the time, like past performance is not indicative of future returns or future performance, or some boilerplate phrase like that. Well, that's not really true. So hedge funds have not done well, and I've given you a reason why they've not done well, and it's because the fees are too high and there's too many assets chasing too little inefficiency. So then if you project this forward and you ask, well, over the next 5 years, what's going to change? Is the AUM in hedge funds going to decline rapidly? Probably not. What that would take is it would take a lot of institutional investors to come to the decision that they no longer want to invest in hedge funds. And by the time they made that decision and then unwind the portfolio, it would take several years, and if not decades. So the AUM is not going to materially change. What else was there? The fees. Are the fees going to change? Well, that's actually a good question. That's because because clearly institutional investors are not happy with the fees that they're paying for these. So there definitely is pushback on the fees. So you can essentially identify that as an ongoing trend, that there will be more pushback in hedge fund fees. Take that as a given. So sure, that could be addressed partially, but if you look at the fees, there's a minimum. Like on the one hand, institutional investors are saying that you need a compliance officer, you need a risk management system, you need all these kind of things. All those things are expensive, and so it means that you're no longer able to run a hedge fund with a Bloomberg terminal and sitting at your desk at home. You need like a large team of people, and so those fees are used to support all that overhead infrastructure. And so, yeah, there can be some pushback on the fees, but it's not going to be that dramatic to really make a big difference in these returns. Then the next thing is, well, are the markets are they going to become more inefficient? So you're going to discover areas where like things get worse? No, in fact, most likely it's the opposite. There's probably an ongoing trend that markets grow, like expand, like different countries will start their stock markets, but so contributing to inefficiency. At the same time that's happening, though, other markets are becoming more efficient, and so the net is, if anything, I would argue that if I had to pick the direction, I would say things are becoming more efficient, not less efficient. So all those trends don't paint or do paint a bleak picture for hedge fund investing. So yeah, so keep that, like, again, this is another example where you can you don't need to do a lot of in-depth quant analysis, but to come up with pretty robust and insightful conclusions on investing. So there was yet another example. So consider that as another one of my gifts to you during this course. Okay, so let me, yes, it's about 7:08. So let me stop sharing. If there's any quick questions, take a quick break, and then we'll come back and we'll go through some slides and watch some videos, and it'll be fun. Okay, I'm gonna unmute everybody in case they want to ask a question. Okay, so I'm going to unmute everybody. I'm going to stop my video sharing, and let's come back at 7:30. So we'll take like a 20-minute break. Okay. Yeah, so here's some of the we're not going to watch all these. I'll just show you short clips of the most relevant ones. But here's a list of some of the famous hedge fund managers. So Cliff Asness from AQR, we'll watch a clip from him, and there's Jeremy Grantham, was an older guy. Bill Gross, also I believe he's retired now. Well, I know he's retired. Well, I know he's no longer working at PIMCO. Ray Dalio, I'll show you a clip from him. He's the founder of Bridgewater, and also advocate for this all-weather portfolio. Warren Buffett, you should be all familiar with. And then Jim Simons, who I've talked about numerous times through the lectures, and I've talked about the Medallion hedge fund. And so he has like there's a long clip on the internet of him giving a speech, but I'll just show you like a section of it where he talks about the very early days where he starts building these models. So it's quite interesting. So let me now switch over and to queue up these videos. Okay, so let's just start with Ray Dalio from the all-weather.
Important thing here, if I'm an investor, let's go back to the investor, is the most important thing is that you can have is a good strategic asset allocation mix. In other words, you're not going to win by sort of trying to get what the next tip is, and what's going to be good and what's going to be bad. You're definitely going to lose. So what the most investor needs to do is to have a balanced, structured portfolio, a portfolio that does well in different environments. So much of the driver of any asset class returns is based on how events actually transpire relative to expectations. So there's a certain discounted growth rate in equities. There's a certain discounted growth rate. There's a certain assets. You can look at what's priced in. And then what happens is you need to have environments, a quarter of your portfolio in assets that do well when growth is faster than expected, or a quarter when it does well and when it's slower than expected, a quarter when inflation's higher than expected, and a quarter when inflation's lower than expected. So you need to create a good structured portfolio. Then you can make your bets. But this is a whole conversation on how to invest.
No, but here's a question just about bets. You're making the argument and explaining the need to have a diversified portfolio. But most people have a diversified portfolio follow the market, meaning whatever the S&P 500 is, ultimately you're going to be up or down somewhere around there. You and some of your peers consistently outperform the market. And you do that, I assume, by making bets.
Well, we break it into two parts. We have two basic portfolios. There is the strategic asset allocation mix, which we call all-weather, and that just has nothing to do with bets. It has to do with how to make all the assets the same risk parity. I would call risk parity. The problem is when people try to diversify and they own some equities, and equities has a volatility that's large, or they own assets that do well when the economy does well and do badly when the economy does badly, they have a concentration of their risk in some assets. They need to change the portfolio. They need to buy longer duration bonds or leverage the bonds or bring up so that bonds and commodities and pieces have comparable impacts, so that whatever happens in the economy will then have a balancing effect. Because the one thing you could be most confident is that asset classes on average will outperform cash. Okay. So if you have, that's a strategic asset allocation. That's what the all-weather piece is. Then there's the bets. The bets are zero sum, right? In order for you to beat me in the game, you're going to, it's like poker. It's a zero-sum game. We have 1,500 people who work at Bridgewater. We spend hundreds of millions of dollars on research and so on. We've been doing this for 37 years, and we don't know that we're going to win. In other words, we work that. We have to have diversified bets. We have a lot of diversified bets and so on. So it's very important for most people to know when not to make a bet. Because if you're going to come to the poker table, you're going to have to beat me, and you're going to have to beat those who take money. So the nature of investing is that a very small percentage of the people take money, essentially, in that poker game away from other people who don't know when prices go up, whether that means it's a good investment or if it's a more expensive investment.
We're going to slip in a quick break. I'm going to send it back to Joe, and then we'll come back and continue the conversation. Joe, he's got a question for you. Scott?
Hi, Ray. How are you? You've done a spectacular job at being able to call macro trends very well and sometimes very aggressively. One of the things that we've noted over the last particularly few months is the use of judicious amounts of leverage on bond portfolios to try to emulate equity-like returns. I think risk parity is what they call it, and you've done a great job with that sort of thing. Is that a mechanic, or is that an indication of direction of attractiveness, relative attractiveness of fixed income to the equity market?
A mechanical thing. The problem of, let's say, a stock and a bond portfolio, if you put 50% of your money in stocks and 50% of your money in bonds, the problem is you have about 80% of your risk in stocks and about 20% of your risks in bonds. And so you don't have diversification. But if you just imagine that you had a long duration bond portfolio or a bond portfolio that had about the same volatility as stocks, and you went through the financial crisis, most of the decline in your portfolio would have been protected because the stocks would have gone up in value by an amount that would have had an impact that would have offset the other. So in structuring a very good portfolio, you have to have basically comparable amounts of risk in that.
Okay, so that was a great example of the kind of the main proponent of the all-weather portfolio talking about it himself. And it was interesting that, it's another like factoid about all these guys you see in these clips. These guys are all like multi-billionaires. So it's kind of weird that I guess probably if any of us were multi-billionaires, we would just enjoy spending money as opposed to continuing to work. But I guess that's why these guys are multi-billionaires. So let me switch over to the next speaker. Is there anything I want to say about Bridgewater? No, I think he did a great job. So it's like explaining it in simple terms. So he talked about like all weather, and he said like all weather is a form of risk parity. He gave the example of like the 50-50 stocks and bonds is not 50-50 risk. So I thought that was like a perfect summary. Let me switch over to the next clip and do the two next. Okay, Cliff Asness. I want to start him at 4:30.
Things for the next 6 months or the next year. But as we look out into 2013, we've had this incredible run in fixed income, particularly in quote unquote safe assets like right. U.S. Treasuries. What do you see in the investment landscape? People talk about inflation and it doesn't matter until it does matter, right?
Right. Well, these are the hard questions. When I talk about these things, I back up, and for the long term, not for the short term, what price you buy something at versus fundamentals, it matters a lot. Mm-hmm. I won't say it's all that matters. You can have fundamentals act weird for 10, 20 years. More often than not, though, if you buy an asset very expensive to its fundamentals, for stocks that's versus its earnings versus its book, for buying a price that's very high or very low. For a bond, it's buying at yields that are very low versus inflation or very high versus inflation. That is a reasonably strong indicator. In fact, it's our best indicator of how you're going to do over the long term. Looking now versus history, versus kind of the 70, 80, 100-year history we all like to look at, stocks are on the more than on the expense. They're about 80th percentile. I use geek terms like that. 80 out of 100 times they're cheaper than they are today on my favorite metrics to look at. And bonds are about 98th percentile expensive, meaning low real yields. Putting it together, this is where I'll depress the entire World Wide Web. Putting it together, you take 60% of where stocks are and 40% of where bonds are. That's about the least attractive ever. Our best guess is a US 60-40 portfolio.
will beat inflation over the next decade. And again, it's a best guess.
And when you talk 60-40, you mean stocks
and bonds.
Yeah.
Will beat inflation by between 2 to 2.5%. Historically, that portfolio, with a healthy amount of bonds, so it's not that risky a portfolio, has delivered 5% over inflation. You can ask yourself a lot of questions. Does this mean forever people are comfortable, the risk premium's lower and we'll make 2 forever? Right. Or are people fooling themselves and at one point are going to wake up and go, no, we really want 5 like history, in which case prices have to fall. Here's where I get to be a coward and only talk about the long term. Picking between those 2 scenarios is very hard. But where this comes in most importantly is planning purposes. In some ways, the whys and the whens don't matter that much. If what you're doing is sitting and saying, how much do I have to save to retire? If you're an institution saying, how much do I need to put away for my liabilities? The fact that the expected from here is 2-3% lower versus inflation than normal, the very least, even if you're not willing to market time, and maybe you shouldn't, by the way, I'm not necessarily advocating that.
Right.
But I am advocating using the current valuations in your planning process, acknowledging reality and saying, does that mean you have to save more, spend less, whatever it is, they're sad messages. But if you're going to earn 2.5 instead of 5 over inflation, it changes your equations.
Right. Now, you said your preferred metric earlier. You were talking about one of your preferred metrics. You were talking about the PE, the Shiller PE, which is a 10-year look at prices versus earnings. It's not the last 12 months. It's not the next 12 months. It's more of a broader look. There are critics of that, of course. Why do you like that metric when you look at it?
I don't want to put words into John Campbell and Bob Shiller's mouth, who came up with it. I'm going to tell you why I think they did, and I think they'd agree. But the idea is particularly in using PEs, there are other things you can look at. You can look at book values, dividend yields. Right. But if you're looking at earnings, one of the Wall Street's longtime favorite metrics to value a stock or the stock market, earnings is a little ambiguous. Over what period do you use earnings? Do you use future forecasted earnings or current trailing? I'll tell you right now, I hate future forecasted. They are always wildly optimistic, and I don't trust them.
I just read today that fourth quarter earnings estimates have been cut in half since October 8th by analysts. Hardly the kind of thing that's steady.
They use optimistic forecasts, then they bring them down all year, and they also tend to focus on what's called operating earnings, which are often sarcastically called earnings excluding bad things. Now, what Bob and Shiller and John Campbell said was 1-year Ps can be very weird. 1-year earnings move around a lot. When they're very high versus, imagine you have a trend. Earnings have grown over time. Thankfully, as the economy has grown, earnings have grown. So earnings have grown over time, but imagine they're way above trend. They tend to mean revert. In geek speak, they tend to fall back to the trend. If you look at a 1-year PE at that time, the E is a little artificially inflated. Something good has gone on that maybe won't last forever. And you'd be using a PE that says it's too cheap. On the other side, it can be even more extreme. When earnings are low, we've seen entire market earnings perilously close to zero. Now, I'm not going to get into a ton of math here, but anything divided by zero is coming out pretty close to infinity. And I don't know, I might be more negative than most, but I don't think stocks are infinitely expensive. That would be a little odd. So what they basically said is what we really want is price divided by some idea of earnings capacity. How much could they earn in a normal world? And they said if I just use a 10-year average of what inflation-adjusted earnings, it's unbiased because I'm always going to use a 10-year average. I'm going to use that 20 years from now. I used it in the past. And they said a 10-year average captures the economic earnings power of the companies in the country. I think it does also. I don't think, by the way, they would be married to 10 years. Their concept is to use a longer window. I've joked in the paper we wrote that if you told those guys, hey, how about 8 years or 12 years, they wouldn't run screaming. There's no magic to 10 years. Right. Right now, 1-year earnings are above trend. 1-year earnings have been strong. A few years ago, they were below trend. I think a few years ago, you'd be too pessimistic using 1-year earnings because PEs would look too high. Right. And right now, they look too low. Some of the critics you've talked about, and this is a raging controversy among 9 of us. I don't know if that qualifies as a raging controversy. There aren't that many people that interested.
It's not quite the level of fiscal cliff,
yeah.
But
the criticism now is not about the technique. Most people writing about it have said it's a pretty good idea to smooth these things, not to use 1 year. But right now, this 10 years is a very weird 10 years. This 10 years includes the earnings destruction in 2008. And now it's pretty much rolled out, but when this fight started, it included in the early days some of the earnings destruction post the tech bubble. So is this too pessimistic? And I wrote a short piece, really a very simple point, saying if you actually plot not 1-year earnings but 10-year earnings, they're above their trend too. It's not been a bad 10 years, it's been a good 10 years.
Even with the effects
even
of 2008.
with the 2008 wipeout. And I can't prove this, but logically, and you can see it in the graph, 2004, 5, 6, and part of 7 were strong earnings. We were in that bubble time. So it's kind of cheating to go, let's not count those 2008 earnings.
But let's count the perhaps
let's
artificially
count
strong.
or use or ignore the fact that it's just a give back.
Right.
And the numbers seem to bear that out. That the 10-year, you see nothing to make you think the 10-year is any less valid than the past. And historically, it's been a far better predictor of the next 10 years' earnings than the current earnings are. So I see no argument on the other side. I mean, I'm trying to be nice about this, but I don't see their point.
Yeah. So it may not be a panacea, but it is a potion for this short-termism that can so often take effect. And
exactly, and you know.
Okay, so that was pretty good. So he was mainly talking about the 60-40 portfolio. So let me make some comments on that. I'm actually just looking at the date when this was done. So one funny thing is that, so let me step back. The 60-40 portfolio, or the 60% equity, 40% fixed income, is the classic benchmark for a pension plan or institutional investor. So no matter what institutional investors do, their portfolio tends to look like a 60-40 portfolio. And so it's kind of like the kind of rule of thumb reference portfolio used in industry. And so that's why he talks so much about the 60-40 portfolio, and then the expected returns for that portfolio, because he's saying these are the returns that pension plans could expect to earn. And so those are very important, because if, and this is the case, and I'm not sure we talked about it before, but pension plans in the US are assuming that they're going to earn 8%. And indeed, they could say, well, historically, we have earned 8%. So that's a very reasonable assumption to make. But Cliff Asness is saying that that's not a very sophisticated way to look at it, because you have to look at it on a forward-looking basis. And so you have to take into account that you're starting from a pretty expensive starting point. And so at the time that this clip was made in 2012, which is 8 years ago now, he talked about how expensive equity and fixed income was. And I think he said equity was 80% expensive, fixed income was 98% expensive, and that the 60-40 portfolio would only generate like inflation plus 2 or 3%. So in other words, he's saying that the real return will be 2 to 3%. And so all that logic was perfectly sound. And he also, remember, at the very beginning, he made a caveat that said, like, things can be unusual for 10, 20 years. So he also made that caveat as well. So 2 points, or I guess one point I would make is that the 60-40 portfolio continued to do well after this video was made. So almost the video is almost like a decade old now, and the 60-40 portfolio has done remarkably well. So his forecast of that 2% real has not transpired. And so let's say in 2012, he was debating with these pension plans saying, no, you shouldn't be expecting 8% return. That's totally unrealistic. Over the next decade, it's going to be more like 2 and 3. He's actually been wrong. And so those pensions could say, well, what makes you think you're going to be right now? Sometimes it can take a long time for these things to play out. Now, it also gets tricky, because remember when he said that fixed income was 98% expensive, but in 2012, like when we sit here today and look back in 2012, from our perspective, fixed income doesn't actually look that expensive. In fact, it looked pretty good. It looks pretty good now. You would love to be able to invest at the yields that were available in 2012, and that's because he used that range of what had been observed up until that point in history. So when he says 98% expensive, he means that if you look at the entire history, you've only observed more expensive yields 2% of the time. But as you know, we've blasted through those low yields. So we've reset the range for what's considered as expensive in fixed income. So things have not really gone in the direction to confirm that Cliff Asness is correct, because in fact, it started at 98% expensive. It went through the lows, so then it redefined what's expensive, and now we're essentially 100% expensive. So at some point, Cliff Asness has got to be right. Just the math has to, work out that way. Even at least for the fixed income part, because on the returns for fixed income are like very mathematically known, meaning that if you buy a bond now at a 1% yield, at the end of 10, you hold it to maturity, you're guaranteed to have earned like a 1% annual yield on that. That's just how the math works. Even if you buy bonds and roll them, you'll still end up, the best estimate of your expected return will be the current yield level. Because if yields go down, you've made capital gains on the bonds, but you get lower interest income from that point onwards. The reverse is true as well. So they tend to balance out. So that's why no matter what the path of yields is over your history period, the return is determined by your starting yield level. So that's what I mean by Cliff Asness has got to be right eventually, at least on the fixed income side of the portfolio. Equities is more uncertain because equities aren't constrained by the math of fixed income, whereas equities can be driven by things like earnings, growth. So you could imagine a scenario where all of a sudden we become, like, let's say there's an AI revolution and we become dramatically more productive than we have been historically. So historically we've been, maybe the world economy grows at like 3 or 4%, and all of a sudden we start growing at 8% due to some kind of catalyst. Then all of a sudden stocks would appear cheap at these levels. So equities aren't as constrained, but still, the odds should be in Cliff Asness's favor to be right, but he's been wrong for 8 years. So that's one of the things about this industry, is that a lot of things are driven by statistics and chance and luck. And in fact, when we go to we'll wrap up by going to video by Jim Simons, and he actually talks about luck in his career path. So it's a good segue into his video clip. So let me start the sharing for that. And I want to start, I think, like right here.
You'll do pretty well. But, and we did okay. But after a little bit, I started collecting some data, and I figured there's something to be modeled here. There's something to be modeled here like we used to do in the old IDA days. So I brought in the best modeler in the world, Lenny, a guy named Lenny Baum from IDA, and persuaded him to come, and we're going to make these models and do great. And Lenny started making models with me, and we were fooling around. But I kept trading, and then Lenny seemed to get less and less interested in models and more interested in reading the news real. In those days, it was just a roll. It would tick away, and you'd read the news. And Lenny was always reading the news instead of thinking about models. And then he started having opinions on what was going to go up and what was going to go down. This was all foreign currencies, bonds, that kind of stuff. And I started listening to him, and he was right. He was right. He was right enough times. I said, okay, the hell with the modeling. Let's just let's just try to make some money. And we had a remarkable run. In the 2 years since I said the hell with the modeling, we multiplied our investors' money by 12. Now that was even after their fees. That sounds pretty good, right? We were incredibly lucky. See, the last word up there is luck. Luck. Good luck. Good luck. And we certainly had good luck. I've had a lot of good luck in my career. So, but in the back of my mind was, well, okay, Lenny doesn't want to build models, but maybe we could build someone else could come in and build models. And another fellow, Jim Axe, who was quite a famous mathematician, left Stony Brook to come and he did build some models. So those next years was a combination of fundamental trading. I did venture capital. I invested in all kinds of things, but the models kept being built and working better and better. And finally, at the end of about a 10-year run, it was clear to me that this gut-wrenching business of fundamental, I mean, you know, if you're doing fundamental trading, one morning you come in, you feel like a genius. You know, your positions are all your way, and you think, God, I'm really smart. And look at all the money I made overnight. And then the next day you come in and they've gone against you, and you feel like an idiot. We were pretty good at it, but it just didn't seem to be a way to live your life, you know. So building models, go with the model. So by 1988, I decided it's going to be 100% models. And it has been ever since in the business that we built. So some firms, you know, investing firms say, oh, they have models. And what they typically mean is, you know, we have a model and it advises the trader what to do, and if he likes the advice, he'll take it, and if he doesn't like the advice, he won't take it. Well, you can't, that's not science. You can't simulate how you would do. How were you feeling when you got out of bed, you know, 13 years ago when you're looking at historical simulations? Did you like what the model said, or didn't you like what the model said? It's a hard thing to back test. So if you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision. So we built a business 100% based on building computer models, starting in those areas that I mentioned, currencies, financial instruments, gradually moving to stocks, and finally to anything that moved. Well, it had to be tradable, it had to be liquid. Was always liquid. And you know, bringing in data. In those days, we sent gals down to the New York Federal Reserve to copy histories of interest rate numbers. I mean, they didn't exist in the 70s. You couldn't go and buy data, and there was certainly not online deliveries of all this stuff. So to build the original models, we needed to collect a lot of data by hand, which we did. And but gradually, you know, we got smarter, the models got better, we brought in more and more people. We have the best math and physics department in the world at Renaissance. I don't think that's quite true. On the other hand, it ain't bad. We have a lot of smart guys, and we certainly hired people who were good at that kind of work. So we started.
Okay, so I think that gives you a great flavor of some of the kind of pioneers in areas of money management and portfolio construction. So one thing I would say about Jim Simons, he's usually the odd one out of the set that I've shown you, because he's not really doing asset management. So he's running like a pure quantitative portfolio. And so it's not like you could go to like an institution and advise them, yes, you should run all your money using quant models. That would be unusual. Rather, more what you do is, if you were able to, you'd say, well, okay, let's allocate some money to people that run these as part of a allocation within a hedge fund. Sorry, allocation within an institutional portfolio. So maybe you would put like 5 to 10% of your money into investors like Jim Simons. On the other hand, though, if you are able to run a portfolio like Jim Simons, it most likely dominates any other portfolio in terms of Sharpe ratio. And I'll give you an example of how the Renaissance process works. And the other thing you notice too, that they were very early, and probably like, if not the earliest, I'm not sure if they were the earliest, but they're very early in quantitative trading. And so you notice that at the very beginning, they had both skill sets. So they said that, or he was saying he did well at fundamental trading, and he just didn't like it. But he also did well at the quantitative trading. And so I think that's like a kind of insight that's glossed over, in the sense that probably one of the reasons why they were so successful is because they had both skill sets, which is rare. Because when you model something, you need to have some kind of idea of what the edge is in that model. So you have to tell it something. And so you have to have an idea of what kind of financial strategy would be successful to implement. So I think they were able to capture both those things, that they had an idea, like they had some kind of intuition about what assets would do well relative to the other assets, and then they were able to codify those intuitions. And like he said, so Jim Simons is a founder. I believe he's, well, I know he's not. I don't even think he's the CEO anymore. I think he's kind of retired, but he still has his money invested in the firm. And I'll tell you a little bit how the firm works. So they had these quantitative models. They opened up the Medallion Fund. They had attracted external investors, continued to do well, and they eventually did so well that they no longer needed or wanted outside money. And the reason is because these quant models have a capacity, so that the more money you put in, it kind of dilutes the models. So what I mean by that is maybe you have like your top 10 models or your kind of your best models, but then and they'll have like a Sharpe of like 0.1 or better. But then and each one can manage like so much money just because of limitations in trading liquidity and all those kind of things. And so then if some external investor gives you more money, then you'll have to go to your next best models. So maybe they will have like slightly worse Sharpe ratio. And then you can imagine, as you go more and more money, you get diminishing Sharpe ratio. So the Medallion Fund in particular is very strict on their capacity limitations. And I believe the setup is something similar to this, that they start the year with about $5 billion. So that's their capacity, and then they'll run it. So this maybe is not literally how it works, but it's like stylized or conceptually, it's roughly how it works. So they start the year with $5 billion, they run the program, and typically they will generate about 40% return a year, pretty consistently. And then they'll charge fees on that, but it doesn't really matter. It's just a distribution. I think I skipped the step. No, I told you that they took external money, and then they did so well that they paid back all external investors, because the external investors were using up capacity that they wanted for themselves, for their own personal money. So, so like I said, they take $5 billion of now it's all their own money, and they run it through the year. It typically will generate 40% no matter what, whether it's like a bear market or whatever, and that will be $2 billion. Basically, Jim Simons takes 1 billion of it and or more, and the remaining is split amongst the rest of the employees. And so that's why every single year you see Jim Simons having like the billion plus uh, income from his hedge fund. So you may call it like a combination of fees and the P&L, but it doesn't really matter because it's all employee money. So that's Medallion Fund, and yeah, and it's if anybody says that oh, like let's say you have a professor and they say, oh, the markets are efficient. In fact, I believe in the strong form of market efficiency, and you could always point to Jim Simons and say, well, here's this like firm that generates 40% returns pretty steadily. And because the returns are so high and the Sharpe ratio is so high, you don't need that much of a track record to attribute it to that recognize that this is skill. So it's clearly skill. So even if you can't come up with any other examples, you can always use Jim Simons as like a counterexample. And I think you only need one counterexample to disprove the case that the markets are efficient. What else I want to say with Jim Simons? Yeah, I think I covered all the points. Oh yeah, that's what I wanted to go say. But the yeah, and the metric to determine between the skill and the luck is the Sharpe ratio. So we talked a little bit about that. About like one of the interpretations of the Sharpe ratio amongst many is that it tells you how long you need before you can tell skill from luck. So since Medallion has such a long track record, that that there's no question that this is a skill-based investment process. And yeah, the other thing you can imagine is that since this is quant modeling and it's alpha processes, we've discussed before that these alpha models decay. So you can imagine that there's people that say, oh, well, if Jim Simons can do this, like we can do this too. And so even if they're not, if they're just a fraction as successful, it'll still be very, very good. So you can imagine that there's that he has a lot of competition from other quant hedge funds. And in fact, there are a number of other significant successful quant hedge funds. So like 2 Sigma comes to mind as an example. So he's in constant competition with everybody else coming up with these models. And so you can imagine that the thing that he keeps as an edge is just more and more sources of data. So remember he talked about having people hand copy data from like yield series from history. And so you can imagine, like, if he was doing that back then, you can imagine what kind of things he's doing now. And so you hear a lot about like alternative data sets. And so I can imagine like Jim Simons has like satellite images, like taking pictures around the world of like parking lots and like transportation routes and stockpiles of mining companies. Maybe he's like tracking ships like across the world and like mapping where they're going and how frequently and how long they spend delivering. And you can just like you can go wild with your imagination. But Medallion always has to be significantly ahead of everybody else in terms of data. And it's remarkable that they've been able to maintain that edge for so long, which is a testament to the quality of people that he's assembled. But you can imagine it's kind of self-reinforcing, because if you got a job at Renaissance, this is the only way that you have access to that kind of money generating engine. So being an employee gives you an opportunity to invest your own wealth into the Medallion Fund. And so the question is like, if you had that opportunity, why would you ever leave? And similarly, because it's so successful, they're able to attract the very best people in the world. So it's a great example of like a quant investing being successful. So it's not like an example. It's not like a good example of asset management or portfolio construction, because you're not going to say, yeah, we're going to like run money by like a quant model and just do whatever the quant model says. That's not a portfolio construction approach. But on the other hand, though, it's great to be aware that that there's investment processes out there like this. And the one thing the other point I would make right before we go to break is that if you remember with Jim Simons, so yeah, the only argument you could make that there may be something wrong with Renaissance is that it's a fraud. And so you guys may remember like Bernie Madoff and how that was a fraud and essentially it's a Ponzi scheme. And but think about like how a Ponzi scheme operates versus how medallion funds operate. So a Ponzi scheme works by like you're always open for investment. There's no issues with capacity, and you always need to attract more and more investing. If you look at how Jim Simons acted, it was the exact opposite. They actually wanted to get rid of everybody else's money because their investment process was so good that they just wanted to keep it for themselves. And if you act like rationally and economically, that's the behavior that you would have. If you've got a capacity constrained money making generating process, you keep it all for yourself. If you try to make the argument that are you as suspicious as a fraud, like the way they're acting is exactly how you would act if you genuinely had a essentially alpha generating machine. Okay, let me open up to questions, and then we'll take it's 8:13. We'll come back at 8:30, and what I'll do is I'll go through an exam question on covering the value add topic, and then we'll wrap up. And if you notice in the slides, there's a section on regression. So I go through like essentially isolating alpha from a hedge fund or any value add process in general is essentially a problem of multilinear regression. And then I talk about some more sophisticated mathematical techniques for dealing with missing variables and like correlated variables. But the spaces evolve beyond what I've covered in my slides. So I tend not to cover them just because there are way more sophisticated methods out there, and they become more commercialized. So either you just do the basic regression in Excel and that's good enough for your needs, or if you really need to do something more sophisticated, you'll get like either more sophisticated packages in like MATLAB and R, or you'll even get like a commercial software vendor that will have like all these advanced methods and like rolling models and all kinds of fancy things. So that kind of middle ground of like a little bit more sophisticated analysis than Excel, but not like full blown like commercial software. That kind of, so to speak, that market is essentially dried up. So that's why I'm going to skip those slides. So anybody have any questions before we stop for the break and come back at 8:30? Okay, I'm going to stop the video and, turn off my video and mute, and then come back at 8:30. I'll wrap up the question. Well, let me put the question on the screen so you have an opportunity to think about it. I don't want to give you the answer, so to make you think about it. So here's the question at the bottom. Yeah, unlike yesterday, it's a pretty short question. So you're presented with two hedge funds with identical Sharpe ratios, and identify 10 additional pieces of information you'd want to make to support a recommendation to invest in one over the other. So and then what I do is I'll go through the list of answers, and in fact actually just um, yeah, I was thinking if I'd forgotten any of the good reasons, but I think my answer is pretty good. Okay, so I'm going to turn my. I'm just going to mute myself and then come back at 8:30. I'm starting the question, and so yeah, this is a question from a past exam. I read it to you before we took for break, so you've had like some time to think about it, and so I'll just go through the list. So I put down 12 reasons. You only had to put down 10, and the order is not that strict. Like it's not as long as you get the order like roughly reasonable, that would be fine. So let's go through, and actually I don't think you can probably think of some other reasons as well. This is just what I came up with off the top of my head, but I probably missed like a couple. So the very first thing you want to know is if you're recommending hedge fund is even if they have the same Sharpe ratio, you want to know what the alpha is. So for example, if you just invest in like S&P 500, it also has a positive Sharpe ratio. So having a Sharpe ratio equivalent to the S&P 500, why would I need a hedge fund to do that? So really, what I don't care so much about the Sharpe ratio in the hedge fund context. What I really care about is the alpha. And then the next thing that you want to know is the investment strategy. And like, yeah, maybe I've got those, like you might need to know the investment strategy before you start measuring the alpha. So maybe I got those in the reverse order. So it's like kind of a chicken and egg argument because alpha is the most important thing, but then you need to know the strategy for the alpha. So I like by strategy, what I mean is I want to know whether this is like a equity long short or a private lending fund. And then yeah, number 3 would be AUM. So the idea behind that is that if the hedge fund firm is too small, it may not be a viable business. And so, for example, we as teachers may not want to be a big portion of the investor base because that means their business is just too tied to us. Like I'll give you an example. Like let's say 80% of their AUM was from one client. Then if that client redeems for whatever reason that they may have, like the reasons totally unrelated to the fund, it's unlikely that the fund would survive that investor redeeming. So we don't want to get involved in situations like that. You could try to argue the other way around too, that like if a fund is too big, that it doesn't have good alpha opportunities because it just doesn't have enough good investment ideas to deploy all that capital, and that has been like in the past that has been a thought process, but it seems to be less of an issue now because a lot of the top hedge funds are actually huge in terms of the AUM. So, for example, Bridgewater is they're a global macro fund, but they manage a huge AUM. AQR manages large amounts of AUM. So it seems to be less of an issue. The only one that's really strict about it is actually the Renaissance, and even Renaissance has they have not opened up the Medallion Fund, obviously, but they've started other funds, hedge funds. So what they say, well, the Medallion Fund is at capacity, but that's because it trades on things like, you know, short technical signals, like you know, maybe like a 2-week time horizon holding period for any particular investment on average. But they say what we can do is we can take the same models, same portfolio optimization, the same universe of data, and apply that to longer term holding periods. And that process itself should still be pretty attractive. And so they've opened up funds to external investors for that. So you kind of get everything that the Medallion Fund has, except for the shorter term models. So yeah, I'm kind of like drifting off topic here, but the idea is that it's not necessarily a bad thing for a fund to be large, because the funds themselves have done a lot of work to study the capacity footprint, and they do a lot of things to be able to deploy a lot of capital. The next thing is fees. So obviously, if this Sharpe ratio is measured on after fee returns, but even getting back to the very first lecture where we talked about like the fees for the blue and the green portfolio, the idea is that if the fees are too high, then that means the gross return target could be unattainable. So again, it's an important thing to know to compare funds to make your recommendation. You'd also want to know if, we talked about the Sharpe ratio just being capturing the first 2 moments, but you want to know about tail risk. So for example, if a hedge fund strategy is private lending, for example, that's very much like a left tail type strategy. In other words, the biggest upside is you simply receive your coupons as expected. So your upside is kind of known and capped, but your downside is if some of these companies go bankrupt. So then you have a much larger downside. So that may not be attractive, as attractive as something else, some other strategy. Liquidity of underlying investments. So we talked about that when we talked about liquidity. So that if one fund is generating a Sharpe ratio investing in public equities, the other one is doing it in private assets, like say private loans, to use the same example again, then the one is able to generate the same Sharpe ratio in public equities is more attractive, all else being equal. Yeah, dependency on key people. So this is what we see. Again, this is an issue that some of the founders have kind of addressed. So it's pretty easy for Jim Simons because he said, look, we just build the model, we run the model, do what it says. So you don't actually need me to be in the office. And so in fact, when Jim Simons left Renaissance, was really, or stepped down as CEO, to be more precise, it really wasn't a big deal because everybody had investment. Everybody was invested in the investment process, not in any particular person. Contrast that to the case of Warren Buffett. So, what happens when Warren Buffett leaves? Will Berkshire Hathaway have the same success? And the answer is probably not. Be just my opinion. So there's an example. Like you'd want to know if one investment was like was very reliant on some key person. You want to know if the process was quantitative or qualitative. So again, you probably have more confidence in the quantitative process than the qualitative process, because the quantitative process, so long as you keep refreshing the models and running them, everything should be fine. But if it's a qualitative process, you know, it's hard to have as much confidence, because maybe that qualitative process only works in certain regimes or for certain reasons, or it's not, you know, maybe it's just like, you know, it's too sensitive to other influences. Capacity limitations. So we talked about a lot in with the medallion fund. So you know, there's not much point in, let's say you're looking at hedge fund investment, and from teachers' point of view, if that fund is only able to take, say, $20 million, it's actually not worth our effort to allocate to it, because even though if it has a great Sharpe ratio, it's just not a big enough percent of the portfolio. So I think that would be like like a basis point of the total fund. So we're about 200 billion. So 1% is a billion. Sorry, 1% is 2 billion. 200 million, 20 million. Yeah, so it's literally 1 basis point of the whole fund. So it's not material at all. So we want to, all else being equal, you'd want a manager that had the capacity to accept more capital. Yeah, lockups or gates. So you prefer that not to be locked up or have gates imposed on you as an investor. Yeah, the ability to allocate more money is very much along the lines of the capacity. So I think one sense was the number 9, the capacity limitation, was more like the limitation of the overall strategy. Like, so the medallion fund has a capacity about 5 billion. But then number 11 is more like the investors being able to allocate more money. So it could be that the capacity is 5 billion, but if they're only willing to take like an additional, like, you know, to use my example again, 20 million, then that's not really much of a benefit for us as an investor. And then the last thing I could think of is probably not that important, but the rest of the investor base. And this more kind of gets to the idea of like the riskiness of the firm. So like, let me try to think. Like, let's take an example. Like the investor base was say dominated by high net worth individuals that were looking for a higher return, and this was like a private asset type fund. And so if you're investing alongside high net worth individuals, they are kind of less sticky capital, which means that if things start to go bad, they will pull the money out pretty quickly. And so if that happens, then you as the remaining investor could get left stuck with a worse off portfolio than desirable. So that's something to watch out for as well. So yeah, so that was this was how, you know, I would just use my top 10 strongest points, and that would be my answer to this question. And let me turn to the sharing, turn off the sharing to see if anybody's any questions. And other than that, we'll wrap up. No, I think you're already unmuted anyway. Okay. So the next lecture tomorrow is on this is where we drill down into the hedge funds and actually get down to the level of what kind of things they think about for trading strategies. And so for me, like personally, it's my favorite lecture actually. So so it should be fun. Okay, so have a good evening for those of you that are in my time zone. Goodbye.